Hi CS students, let's revise CA Final AFM practical question 25 of chapter 5 security valuation. ABC Limited has 300 million 12% bonds outstanding with 6 years remaining to maturity. Since interest rates are falling, ABC Limited is contemplating of refunding these bonds with a 300 million issue of 6-year bonds carrying a coupon rate of 10%. Issue cost of the new bond will be 6 million and the call premium is 4%. 9 million being the unamortized portion of issue cost of old bonds can be written off no sooner the old bonds are called off. Tax rate is 30%. You are required to analyze the bond refunding decision. So since it is a refunding decision, we have to use NPV approach and we have to see whether the refunding decision is beneficial or not. Okay, NPV approach, we have to follow the incremental approach wherein we have to check what will be the savings and what will be the extra cost cash outflow involved, and then we'll arrive at the NPV. If the NPV is positive in this incremental approach, then we can go ahead and refund the old bonds and issue new bonds. For NPV, in case of NPV approach, we will be calculating initial investment, then in between cash flows, here it will be savings, then finally the NPV. Now for this initial investment, we will be calculating using the face value of the bonds, old bonds is 300 and call premium is 4%. So 300 into 4% will be 12 million. So the cost of calling old bonds will be 312 cash outflow, and gross proceed of new issue will be 300, and here also issue cost is 6 million which they have given. Call premium, issue price which they have given us 6. So if we reduce 6 from this 300, net proceeds of new issue which will be receiving is 294, and there will be some tax savings on call premium. Why? Because call premium and unamortized cost. Why? Because call premium can be amortized since the call premium is a deductible expense in income tax, and the amortized cost also can be written off in this year and claimed as a deductible expense, since 30% of the tax can be saved. So the cost of old bonds 312 minus the gross proceeds of new issue 294 minus the tax savings will give us initial cash outflow, which is 11.7 million in our case. Going further, we have to calculate the in between cash flows. So here the in between savings we have to calculate. As we know, the interest rate is reducing from 12 to 10%. So there will be annual interest expense savings. So 300 into the differential 2%, 6 million will be a saving for us, because we will not be paying to the investors. But there will be some loss on tax savings on interest and amortization, because the previous in the case of previous interest, so it is 300 into 12%, 36 million, but in case of current it is 300 into 10%, which is only 30 million. So on this 6 million interest, we will be losing tax, because the more interest expense, the more tax deduction. And in the same case of amortization also, the old bond unamortized amount is 9 million as per the question, but the current call premium is just 6 million. So 3 million will be the differential portion. So if we divide it by the outstanding years, 6 years, which will come up to 0.5 million. So on this portion also we will be losing the tax benefit. So 1.95 will be the loss on tax savings overall. So 6 million interest savings minus the tax savings which we are losing, 1.95, will give us annual net cash savings of 4.05 million, which we are discounting by the 7% as given in the question. So the discount factor in question they have not given. It might be a typo, so we can ICAI has taken 7%, but they have not mentioned in question. Fine, we'll be going ahead with that. 7% and then 4.766, multiplying this two will be getting 19.30 as the present value of net annual cash savings. Now minus the initial outlay which we are spending, 11.7 million. So the net present value of refunding the bond will be 7.6 million. So the bond should be refunded as the NPV is positive. Thank you.